I always want to find out what they've owned, what they've closed on recently, what dollar amounts that they have purchased. Do they have their capital readily available, or do they have to raise their equity? In some cases, we have buyers, and actually it's becoming more prevalent, that have the ability through a line of credit to close with cash in 30 days.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
Hello and welcome to episode 35. If you are an active investor in commercial multifamily and apartments, or you're interested in getting into this space, I know you're going to get a lot out of today's conversation. I'm very excited to be talking with Craig Black and Scott Nurski. Both of them are multifamily investment advisors with NAI Wazinski of West Michigan, and we have definitely packed a lot of information into today's conversation. We'll be talking about what you need to do to get brokers to take you seriously. If you're looking to get into this space, you definitely need to know what a broker is looking for if you want them to show you the good deals. We're also going to talk about the economy of scale that you can achieve with multifamily and apartments, factors and expenses you need to consider when moving from the single family or small multifamily to the larger multifamily or apartment investing space. And also in the second half of today's interview, we spend a lot of time talking about the Michigan market. So if you're an out-of-state investor or an international investor, and you really want to understand the Michigan market better, you definitely want to listen to what Craig and Scott have to say, and they share their insight as to where the opportunities might be. Craig and Scott, thanks for being here.
Thank you for having us.
Thank you.
Why don't we start by just each of you tell me a little bit about yourselves and what you do for NAI Wazinski.
Scott and I are involved in multifamily acquisitions, dispositions, typically with properties 100 units and larger in the West Michigan marketplace, although we do work out transactions throughout the state of Michigan, and we work with buyers and sellers all over the United States and sometimes outside of the United States. And basically what I do primarily is I get involved at the transaction side, and my job is to work with buyers and sellers in negotiations, financing aspects, and operational interests in their property.
So we kind of have complementary roles. I have a finance background, and I typically am doing the underwriting, so analyzing the financial statements of a property and coming up with a presentation to show investors, as well as directing the marketing end for marketing properties, and then also we do some of our own marketing for ourselves. And then on the administrative side, working with our staff and so forth to assemble information and arrange tours and doing those types of things.
And I know, Craig, you said you're typically over 100 units. Give me an example of some of the deals that you've done.
We did a deal here in Kentwood, Michigan that was 306 units. It was an acquisition by an out-of-town purchaser that came in and picked it up as a result of a 1031 tax-free exchange with the sale of some assets outside of our area.
Yeah, one of our most recent sales, larger sales, we did a 180-unit apartment community in the Kalamazoo area. And that was what we call a value add opportunity. There was the opportunity to purchase the property and then invest additional capital into upgrading the units in order to achieve a higher rent that the market would bear.
What was unique about that asset, it was actually going way back in my time frame. It was a brand new property when I was going to Western Michigan University back in the olden days. Now it's a 1968 vintage, which Scott said is a value add to go back and retrofit and upgrade the property and achieve higher rents. Right now it's currently a mix of some students and some market rate tenants that are living at the property.
I know both of you are also real estate investors yourself.
I used to have a securities license and actually a principal's license, and we raised equities through our broker dealership to go out and redevelop other properties. So,
so you've been involved with syndications.
Yeah, and that's what we did. We went out and raised our equities, anywhere from $1.5 million to $2-3 million, and then we went out and developed other real estate properties. Actually, I sold my last 180 units to individuals when that housing market everybody started moving out of multifamily and going to single family homes with no money down, no doc loans. converted it into condos, and I got 180 condominium units. I still manage the property for the association, but my ownership of that property, I've divested myself from it.
That would have been before the crash then back then.
Yeah, it's a little of both. We started it in 1998 on the conversion, and we got out of the last unit we sold in 2004. So yeah, just prior to.
And what about you, Scott?
I only own a duplex at this point.
Okay, so you manage it yourself?
Yeah.
How's that experience for you?
Landlord life is has its ups and downs for sure, but generally if you screen tenants well and you've got folks that have a good rental history and are just generally seem like they care about their living environment, things tend to take care of themselves.
Yeah, and this kind of brings us to the topic that I think a lot of our listeners are interested in is maybe they've been investing in duplexes, single families, but they understand the power of multifamily and apartment investing. I'd like to go in that direction. And let's start by just talking about the differences. And you both, we talked about this off mic, the differences between owning a duplex or a single family versus owning a 100 unit or 200 unit apartment complex.
The biggest difference is efficiency of time and management. If I have 150 units, I can afford to put a manager on site, I can get a leasing agent on site, and I can get a maintenance guy on site, and I can work from wherever. Most of the work as an owner or an asset manager when you buy larger properties is typically going to be oversight of your property and or your management company. If you have a third-party management company, you simply have your meetings with the management company, make your visits to the property. The people on the property are typically employees of the management company, so you don't have issues with workman's compensation or hiring and firing employees. They belong to the management company. When you get into smaller properties, which is how we all started, including myself, you manage it yourself. And then when there's a call late at night to come over and fix a plumbing fixture or the power went out or something happens on the property, if you don't have enough units to support a third-party management company or have your own management company with employees to do those services, you're on your way out at 2 o'clock in the morning to fix the problem.
Yeah, there's definitely some efficiencies that occur when you get into a larger number of units on one site. So for instance, if someone is buying single-family homes or duplexes or fourplexes, and you want to start to build up your cash flows by having more units, well, suddenly if let's say you've got 30 units, but it's spread out over a dozen or a couple dozen properties, you've got a couple dozen roofs, a couple dozen driveways, more mechanical units. So the efficiencies of having all those units on one site is that it just makes it easier if there are service calls. It's easier to buy things in bulk if you need more new appliances or something like that, or buying carpet. Having the ability to have a maintenance person handle everything in one site makes a big difference as well.
There's exceptions though. Saturday night, I got a call from the condominium association at 12:30 in the morning. A guest had come to visit one of the condominium owners and decided to help his sister out with a water shutoff valve that she couldn't quite get closed. He was strong enough to show her how to close it, and he snapped it off, and water flooded their unit and the unit down below. Unfortunately, my maintenance guy was gone for the weekend, my manager was gone for the weekend, and my phone rang, and I was there till 7:30 in the morning with modernistic carpet guys sucking out water, and the fire department cleaning up some stuff and shutting off water mains, and meeting insurance adjusters and plumbing contractors all through the night. So even on large properties, sometimes depends on your management relationship. I happen to have my own property management company outside of what I do here. And as a result, it's not a large management company, and so we don't have a large number of employees that I could have picked up the phone, but the only two people I needed to pick up the phone to were both gone.
Oh, what a convergence of bad events there.
And this week I'm working with 3 different insurance companies and adjusters trying to decide who's paying for what.
That's always a pleasure, too.
It is.
Yeah. Not to mention how much modernistic can charge to clean up that
especially when they know an insurance company's paying. The other problem you got 2 displaced owners on the property that now have to go stay in a hotel till we get it all taken care of.
Yeah, wow. Okay, well, at least you know who's at fault.
We
at
do.
the end of the day.
Yeah.
So let's talk about the investor. I know you guys get calls from all over the country and maybe even internationally, people calling you. And pretty quickly, I'm sure you can figure out if this is someone who's got some experience or if it's someone who's looking to get into apartment investing and maybe does not have a track record. Can you talk about that? What it is that you listen for when you get a phone call from an investor that tells you how serious they are?
I always want to find out what they've owned, what they've closed on recently, what dollar amounts that they have purchased, and then do they have their capital readily available, or do they have to raise their equity? Or in some cases, we have buyers, and actually it's becoming more prevalent, that have the ability through a line of credit to close with cash in 30 days. And I'm not talking on small properties. We're talking properties that range anywhere from 10 to $100 million. They have that kind of equity relationship.
They have $100 million cash that they
cash or a line of credit that's accessible. Scott and I closed a deal here in Grand Rapids where the buyer came in out of Nashville. Seller had a dilemma that he had a master lease on his property with a neighboring property that was expiring, and the neighboring property thought they had a first right of refusal to purchase that had expired at one point in time. And so they were going to walk off and leave the property. So the owner, who lived in Florida, asked us to find an intermediary for property management. In the meantime, we generated 5 offers on the property, and we closed it in 10 days after the purchase agreement got signed. They flew up on their plane from Nashville, brought a whole team of people to the property to go through and do the structural and financial due diligence, and they had cash to close.
So you're dealing with pretty high-level investors then, who
in most cases
have a lot of cash and experience.
And then the other thing is, who's going to operate the property? Do they have a third-party management group? Is it going to be themselves? Do they have a track record? Partly because depending on the financing mechanism they choose, and a lot of people in the larger properties are looking for non-recourse debt, meaning they have no personal liability to the loan. If they're going to do that, the lender is probably going to be a lender like Fannie Mae or Freddie Mac or HUD. How long does it take to close? If they're going to do that, do they have any history with any of those lender types? And if they don't, they may have to have a third-party management company ready and available who does have the history so they can get the financing approved.
So management is an important aspect.
Management history is a good is a good thing, and Scott and I constantly track management companies and investor groups, so we have a good understanding of who does what well, and how many people close on deals, how many people want to come. We use the word retrade deals. They come in and try to tie up the property, looking to be in control of the purchase agreement. In the expectation on their side is they're always going to find a way to get the price back down for due diligence inspections or something. They think and a lot of these guys know what they're going to do with those properties in advance, and that's how they trade. But we have other people who don't retrade, and we typically look to them more favorably than we do the guys who have a history of doing the other.
So when you say retrade, you're talking about the people who try to renegotiate
the deal. And they are, the first thing they do is once they start their due diligence, they're just looking for ways to get the price down.
Mm-hmm. And then that reputation stays with them.
It stays with them. It precedes them, and they have a history that we can follow.
A lot of our investors or listeners may be, like I said, trying to get into this space, and they don't have everything you just said. They don't have $100 million liquid, a line of credit. They're just starting out. What would you recommend to them that they need to work on in order to bring to the table what you like to see in a potential?
Back when I got started, limited partnerships were the way to go. They were expensive, they were timely, and you had a lot of disclosure documents you were required to put together. Today, people are using limited liability companies, LLCs, and in doing that, if you can convince some partners to come into your transaction, you may have $20,000, $30,000, $40,000 of your own, and you may have 10 other people willing to put in the same amount of money. It gives you the ability to buy something larger. You are going to have to split the pool of cash flows and residual proceeds at sale, but you may be able to gain a management fee. You may be able to get an asset management fee or partnership administration fee in addition for you taking the lead on the property. There's acquisition fees that some developers charge their partners for having gone out and structured and put together the entire transaction. And then on the backside, they typically get a bigger residual portion of the sale after they've produced a certain return to their investors than the investors would otherwise by their basic ownership interest. So lots of ways you can do that and structure those. It takes a little bit of attorney's fees, and it takes a little bit of direction and guidance, but that's typically how the small investor transitions from a small asset. Now, some guys have 8 or 10, 15 small properties, and they may at this point in time have paid them down substantially and may have enough equity in those properties that they can do a refinance, pull cash out, or sell an asset or two and move forward because they've benefited from the slow economy in 2006 through 12. Their value might be significantly different than where they purchased it at, and so they might be able to trade out of those options.
The Rental Property Owner and Real Estate Investor Podcast is brought to you by the Rental Property Owner Association, providing services and benefits to Michigan investors for over 48 years. The RPOA benefits and services include investor networking, property management and investment forums, tenant screening services, free limited legal advice, education, national and local discounts, and lobbying for the industry. Receive a 50% discount on your first-time membership with the RPOA by calling 616-454-3385 Monday through Friday and mention this podcast. Once again, that's 616-454-3385. The RPOA, where over 1,300 Michigan landlords and real estate investors go for success.
It sounds like your recommendation is know where your money's coming from, whether it be you're syndicating and pulling together a group of investors, or you're pulling equity out of properties you already own. Make sure that when this particular investor, whoever they might be, picks up the phone to give you a call,
they have access to the funds.
Right. Not that they're going to find a deal, have you find a deal for them, and then
give me 6 months to go out and raise my money, please.
That's not going to work in today's market.
No.
Yeah. Also having a familiarity and understanding with what type of financing is available and who are the most likely lenders. So as you get into various levels of capital need, who is borrowing in that space tends to change. So if you're under $1 million, it'd be a local bank. They'll do much larger deals than that. But as you get into larger borrowing requirements, there are other types of entities. Life insurance companies lend on commercial real estate, which is larger apartment communities are considered a commercial asset, as well as Wall Street actually lends money through banks such as Wells Fargo. That's called CMBS.
Commercial mortgage-backed securities.
Yeah, so there are several options there. So if you have an idea ahead of time, you're going to be much more efficient when you're looking at properties. If you make an offer and you know where you're going to be able to get your money from, both on the equity and the debt side, having a strong understanding of the due diligence process, it's not tremendously different than looking at a single family home or a smaller residential investment. You're going to have a lot of the same check boxes, looking at the physical aspect of the property, borrowing money if you're going to do that versus pay all cash. So connecting with the lenders. There are some surveys, appraisals. A different item would be versus a smaller property needing an environmental report. So a phase 1 environmental report is the standard report that looks at any potential environmental contamination on the property or any nearby properties that have had contamination and could affect the property that you're looking at purchasing. So maybe there was a gas station 4 doors down that had a tank leak 50 years ago. That could still be producing an impact on the apartment community that you're looking at buying. So there's some additional things that you need to know to look out for, and we coach investors through those points.
Something else that, and Scott used the word again. Oh, I'm sorry, I'll move up. Yeah, Scott used the word value add. Sometimes the value add is to the buyer when they look at it and say, boy, this is great. I can do this, and raise my rents, and my value on my property is going to go up. But we do a lot of the value add for the seller. We just recently sold a property, smaller property, and it was, I think 42 units. Market value was probably about $1.5 million. And when we went through and looked at where the guy was as far as how he was operating his property, the rents he was asking for his units, he was far under market and just needed to do some things to be able to bring it back up. And we just recently sold and closed that for $1.9 million. So he had a $400,000 gain just from doing what we asked him to do to make his property more marketable. And we're doing that with other people right now. We've actually helped several people raise market values on their properties, and some of them still own them and are happy with the additional cash flows, and others we've helped sell.
And when you say raise market values, then it sounds like you're talking about get your rents up to market where they should be.
Get your rents up, get the condition of the property in good shape so that somebody doesn't come in and over retrade you by saying it's going to cost X when it's not quite X to fix it up. It's a lot less than that. We're working with a property in the Kalamazoo market where the owner's out of Virginia right now, and the parking lot has $400,000 worth of work to do on it. He's got probably $15,000-$20,000 in landscape improvements that would really dress it up from a curb appeal. We had a property we looked at in Michigan. It's a phenomenal property, but no curb appeal. You drive through, the landscaping's all overgrown. It's 40 years old, but the trees are about the same, and so are the shrubs out front. So everything's overgrown, and unfortunately, the guy's spending money on new toilets instead of stuff that we recommended, and would give it a much more attractive draw from people driving through the property that want to stop and rent, because sometimes they won't stop and rent just because of the outside condition of the asset.
Sure, yeah, curb appeal is very important. Mm-hmm. So you'll recommend spend some money before you put it up for sale, and that'll help you achieve a higher.
Spend some money.
Potentially. Yeah. So it's strategically, if there are items that are going to create a detrimental effect on value, we want to identify those, quantify those, and then depending on whether or not there's a payback. So again, he mentioned a $400,000 item. Well, the real concern there is if we leave that issue unaddressed, will a buyer come in and subtract more than $400,000 off of the value? Will they perceive a larger deficit to the property than what it actually costs to fix the issue? So we're just trying to make sure that no dollar is being left on the table for a seller. Obviously, every seller wants to maximize their return on their investment. And if it's not that, then maybe it's something on the income side where do they really have a strong understanding of what the market will command and what their surrounding competing properties are offering versus what the subject property is offering for its price point.
Or are they better off with one maintenance man and subcontracting out some other services so they don't have to pay for health and dental insurance and FICA, FUTA, MESC? You may be better off because your efficiency. You might not need 3 guys because one of them's working and 2 of them are watching on a lot of projects.
That's the operational side of things. So there's all these different elements that can impact value. So we want to look at all those things, look at it holistically, and make sure that the property is performing optimally before it's shown to investors.
And that's part of the skill and expertise that you guys provide as brokers is you can come in and say, look, this is where you need to focus your money and your attention in order to get the best sales price.
Absolutely. Yep. And getting the story told the right way to the right investors.
I want to go back to the cost for investors who may not have bought multifamily or apartment communities yet, because I know when I made that transition from the smaller multifamily to the larger apartments, it was kind of a shock as to the additional expenses that I incurred both on the purchase side and then just on the compliance side. Can you talk a little bit more about that as well, please?
Go ahead.
Sure. I mentioned environmental reports. So a lender will most likely require that a property has been screened to make sure that there aren't any contamination issues on the property. The lender's looking at it for their own benefit, that if they were to have to take a property back in the future, that there aren't going to be some additional liabilities for them. Appraisal costs can be substantially higher. If you're looking at a larger asset, you may have a higher level of requirements for the survey. And so there's something called an ALTA survey, which is a more detailed survey where they're documenting additional aspects of the property that wouldn't normally be shown
easements and
on a
right-of-ways and
correct, versus like a boundary survey, which is showing the corners of the property and maybe the boundaries of the building or buildings. Loan fees can be substantially higher.
Yeah, Fannie Mae right up front will ask you for $18,000 to do your appraisal, your environmental, and some physical due diligence, and then an underwriting fee. That's before you get to anything else. They'll also, when you go to lock in the loan, they'll want probably a half a point up front to lock in that loan and that loan rate.
That's up front before you even close.
It's before you close, and then
That's meaning 0.5% of the total loan value that you're potentially going to
then what
borrow.
they'll do is they take that 0.5% and they give you a credit for some of it, and the rest they keep as their fee. So there's when I say that, just the loan fee could be 0.5 of 1%. If you get a $10 million loan, that's $50,000. But then there's other lenders who aren't what we call direct underwriting type lenders, and they'll charge another 0.5% for their own fee in house. So instead of $50,000, it could be $100,000 to get that $10 million mortgage. So just different costs associated with different loans. You have a HUD loan that might even be more costly and certainly more time consuming because they have more requirements on their approval process.
But they give you better terms as a
they'll give you
offset.
the trade-off is instead of a 30-year amortization, they'll give you 35. They have low interest rates, which is appealing, but they also have pretty demanding requirements from a reporting side, which some people choose to avoid.
Yeah, definitely the compliance and the reporting side can be, it can keep someone pretty busy throughout the year, just giving them the reports and the information they need. What about the reserves that they require you to have and quite often put up at the close?
Basically the reserves are critical.
You're talking about capital replacement reserves.
You have your capital replacement reserves, you have your tax and insurance reserves, and
those are escrows, we call them. But
mm-hmm.
the escrows for taxes and insurance, they're going to take probably 6 months worth of taxes and insurance up front, and then they'll take the balance of that and amortize it into a monthly payment structure going forward. But they want to make sure that there's adequate dollars set aside so when the tax bill comes due, there's definitely going to be dollars available. When the market went soft, one of the things a lot of apartment owners did, and I won't say just apartment owners, a lot of commercial investment real estate owners did, is in their mortgages there was a provision that says if you can't pay them, we get to add them onto the loan and just re-amortize them. Well, if you didn't have the money, the first thing you did was allow the lender to re-amortize the loan with additional debt on the thing. And that was good as long as properties were appreciating. But when the properties went the other way, you had properties that were over-leveraged. And a lot of those loans got called due, even though you were making your payments every month. Regulatory requirements said the bank can't loan more than 75 or 80% of the market value of the property. And if you were over-leveraged, they had the right to call those loans due. So there was some risk in that. And then the other types of reserves, and Scott just mentioned it briefly, was replacement reserves. I was fortunate when I was in the development business that we did set aside capital replacement reserves.
This would be for
replacement of
items.
Parking lots, hot water heaters, boilers, furnaces, roofs, window replacement. If you did, typically it used to be that they would let you keep those off your income statement and put it on the balance sheet, but you didn't have to identify it on the income statement. And the reason developers or owners didn't want to do that is they wanted to show a higher net operating income, and they said, well, that's capital reserves. Those are replacement reserves over there. Those aren't an operating expense. They're only an operating expense when you got to fix something. And there were a lot of people who didn't set aside any reserves, and when the roof started having problems, they couldn't fix them. When they had a parking lot that had potholes all the way through, they couldn't fix it. When they had boilers or hot water heaters or furnaces and air conditioning units that went out, they couldn't fix those. Properties went downhill. Once your property goes downhill, your rents can't go up anymore. Your tenants start to move out. Your vacancy factor is a whole lot worse. And then, typically what happens, and Scott and I saw this whole cycle, is they were going back to the lenders. And then they become, real estate owned from a lender standpoint, and then the lender has to try to, sell the property at whatever rate they can.
Yeah, so ever since the crash happened, it seems like lenders are very much insisting on having a certain amount per door set aside.
Absolutely, yeah.
reserves.
And it's smart. because if you don't factor that in, even a buyer should factor it into their net operating income, and because we use capitalization rates as an index trying to, determine how a market is in terms of, market values. Everybody wants to get that net operating income as high as they can, and if they can get reduced reserves, maybe the property should have $400 per unit per year. In a lender that only made them set aside $250 per unit, they're going to be a shortfall somewhere down the road.
So typically, when we're underwriting a property, looking at the financials and determining value, we are going to incorporate a line item for replacement reserves of between $250 per year per unit to as high as $500 per year per unit. And that will depend on the age of the property. So if it's a brand new property, obviously the roofs have their full life left on them, or the majority of the life. Same with parking lots, furnaces, air conditioners, those types of things. If the property is older or is a property that has higher turnover, so the more turnover you have, the more tenants come and go through the property, there just tends to be more wear and tear. So some student housing tends to have a higher turnover rate. We would gear toward the $500 number. It's very rare that we actually use $500. $300 to $350 is pretty typical. The majority of rental housing out there in our market, in the general West Michigan area, is between 10 and 30 years old. And so $300 for the newer range, end of that range, and $350 for the older end of the range, unless there are a lot of neglected items.
Mm-hmm. And with certain loans, I'm thinking of a HUD loan specifically, those reserves per door, they want you to have that at close. Like they want to reserve that at close.
Not only
pre-fund,
yeah. And not only does HUD do that, HUD has an inflation factor in their reserves, knowing that the cost of that furnace is going to be more the next year and the next year and the next year and the next year. So there's an index that could create.
It's a more stringent approach.
Yeah.
Yeah. So each year they increase the
reserve requirements go up.
Yeah.
Depends on the lender.
But
some lenders are more lenient.
But HUD's mandatory, and when they do that, they absolutely have a factor in there for it.
But it's definitely important for investors to realize when they move into this larger space, the apartment, and they're dealing with the Fannie Mae's or the HUDs, that they have to take into consideration as their closing costs a lot of the extra money that they're going to have to put.
And if I were a first-time person jumping into a larger investment in an opportunity like that, I don't think I would go out and try to leverage the property quite as high as I would if I had track record and experience and understood market conditions in real estate cycles. Because all you got to do is go in at the wrong end of a real estate cycle and think life's good forever, and you make some wrong assumptions and you're in trouble. I think the first time you go in, if you buy at 70% loan to value, you can probably sustain just about any additional market condition changes that come about. But I wouldn't go in and get an 85% loan and take that risk, especially if you're investing other people's money. That's even more difficult, because the last thing you need to do is have what's called a capital call, when you can't make your payments anymore and you got to call those investors and ask them for additional funds.
Yeah, that's never a good phone call.
Nope.
Yeah. What other advice would you have for investors who are looking to get into this space?
I guess the biggest thing is don't be over optimistic. The biggest problem we see investors looking at in any given market in any given time is they make assumptions that aren't realistic. Rents are not always going to go up 5 and 6% per year. Scott mentioned that earlier. The stabilized rate's probably safer at 3%. But you also have to understand your operating costs are going to go up equally as high, 3-4% per year. Only difference is your operating costs are typically only 50% of your gross revenue, so they won't go up as much. So if you get a 3% rent growth and a 4% expense growth, you're digging in a little bit to your operations, but you're still going to have rent growth and net operating income growth as a result.
As brokers for NAI Wazinski, what do you guys do different for an owner who might be looking to sell than some of your other competitors out there?
Well, our primary goal is to generate the highest sales price possible in the shortest period of time possible with the least amount of issues or complications during the process. So we very much want to control the process. We want to look at all aspects of the property, the physical condition, the operational condition, what is the market doing around the property, and make sure there are no stones unturned in presenting potential value to investors. So that's a very thorough process that we go through. We put together something called a broker opinion of value. It's a very detailed report, almost like an appraisal, but we can't call it an appraisal. We're not appraisers, and the purpose is to define value in the market given what the market conditions are at the moment. So it's not the same as an appraisal, covers some similar territory. We're going to...
Different than appraisal, though, it also has recommendations of things you can do for the property to enhance it, what you should be able to do with your rents to, bring greater value to the property. But that's a positive for the seller, because he can look and say, you know what, I really should do this, or I could have done this, I should do this now, or you know what, I don't really want to do it now, just bring me the best offer you can.
And the buyer sees it as upside potential.
Yeah, we call those positioning recommendations. So there are often things that rather than taking the property to market immediately, maybe there are a few things that need to be done in order to adjust the operations on the property. It might take a few months for that to play out in order to have the property reach its maximum potential. So it's not about just getting it done quickly, it's about doing it right and generating the highest dollar. Once we take a property to market, we move very quickly. We've done so much homework on the front end that we're able to produce an offering memorandum, which is the documentation and brochure that we would send out to potential investors that answers most any question that a typical investor would have about the assets. They can get a very strong feel, even if they're coming from a market outside of the local market. We have a deal room, which is the back end of our website, which allows us to store these documents so that when folks are interested, they can log into our website and very quickly access those documents, the financials, income statements, rent rolls, any type of supporting documentation, physical information, photos, aerial photographs, all these different things, as well as a very detailed market analysis. And so we're able to get information out to the market very quickly. We have an expansive database of investors, and we know who a lot of the main players are who are actively investing. And using this process allows us to generate offers quicker and at higher prices than an investor or an owner may otherwise see.
What advice do you have for owners who might have multifamily or apartments out there that are thinking of selling? What would you say to them right now?
Call us. We would love to meet you and just learn more about the asset, how it's operating, and what it's not. Properties don't function on their own. There's always a greater story, a greater context. Every owner has their own story about why they've invested in real estate, what they're looking to get out of it, what are their long-term goals. And so we want to understand the people side of it as well, and then help craft recommendations according to each investor's plans and goals.
Scott and I, on a regular basis, take one day a week to travel. And part of that is to drive through properties that we know property owners have that have considered selling, or they want to know what their market value is compared to neighboring properties. So we'll go down and visit. Yesterday we were in Lansing, we were in Jackson, we were in Battle Creek, and we came back up through Middleville. And the whole time frame was, besides some meetings directed at becoming more familiar with some of our clients' properties.
So for people who are in Michigan, what areas do you cover that you would travel to?
Basically the lower peninsula of Michigan.
So anywhere in the lower peninsula.
My car says I'm 7,000 miles over on my lease, so yes.
So it depends on property size. Craig had mentioned that we're typically working on properties that are 100 units and larger. Part of that's a function of the fact that we have a team where, in order to be able to rally the amount of resources to do things well, we need to be working on properties of a certain size to make it economically feasible for us. We have a database of every property 30 units and larger throughout most of lower Michigan. And so this gives us a tremendous vantage point on what's happening in the market. Who are the players? What are the values of the properties? What are the trend lines? What are the healthy wealthy areas? Where are the areas of untapped opportunity? So we can see a lot of patterns through having that much data. And that's part of how we're able to give a more detailed recommendation that puts owners or buyers in a better position when they're looking to enter into a new investment or exit an investment.
It really seems to me right now, and we're talking in August 2016, there's just this huge lack of inventory, and you're seeing prices driven way up. Talk about that and where you guys see the market heading and what you think the opportunity is right now for sellers.
Well, it's a supply-demand thing. There's more demand than there is supply, which is, besides rents and net operating incomes going up, it's where am I going to put my money? And if I've taken capital out of another investment, or if I've refinanced and pulled cash out of that existing investment, and now I have 30, 40, 50 million dollars to place, where am I going to put it? And if I'm one of about 200 people coming into a market that all have excess capital and no product to buy, it becomes a bidding frenzy. So the sellers benefit tremendously from that opportunity, which is why you'll see a lot of properties being taken out to the market unpriced by real estate brokers. And the reason being is you typically could have priced it at a certain cap rate in a given market, but if there's capital coming from outside markets and you try to make a determination of what their yield requirements are going to be without knowing what they're willing to pay, you're better off taking it out unpriced, looking at 4 or 5 offers that might be in excess of what you thought the existing market value would be, and then sorting through those offers and find the best player.
So that's why I'm seeing all these large apartment communities come into market unpriced.
Mm-hmm. Nobody really knows what the bid war is going to create, and why establish a baseline when it could be higher.
So since you have the inside track on that, what are you seeing? I mean, obviously when you put a property on the market, you have an idea of what it could get. Are you seeing a lot of offers coming in?
We typically give the seller a range of values that they might, with a realistic expectation somewhere in the middle. If your property is not attractive to a large number of investors, you probably get this number. On a reasonable offer, you should probably expect to get this. On a bid basis, there's a likelihood you could get this. And so we give them that, and we typically look to offer the property we tell the seller that, be realistic and understand you probably are going to get the mid-range value. But if we do a good job marketing and pursuing other investment opportunities or investment groups to come into the deal, then we might get multiple bids on the property, and you might find out you're really in better off position.
Craig had mentioned it's a function of demand. We've got more capital than we have places to put it, and investors are always looking for a higher yield and lower volatility. And so you have the entities, the real estate investment trusts and private investment groups who are purchasing the assets, but they often are going to have investors within their entity they're individually looking for a return on their investment. And they're going to look at their alternatives, which includes stocks and bonds and commodities and things like that. Obviously, keeping money in the bank, cash in the bank is producing almost no return, something like 0.25%. And there are certain, I guess it depends on how you look at the stock market. The less versed an investor is in the stock market, the harder it is to make good, educated decisions and control money and returns. With real estate, it tends to be more stable. It's less liquid, but it's more stable. And that stability has, I think, really been drawing more investors into the real estate realm as the stock market becomes a little more uncertain. It's more affected by the political environment and blips in the economy than real estate tends to be.
Where are the areas of opportunity that you see here in Michigan?
Southeast side of the state, the Farmington Hills, Livonia, Novi, Troy area down there. Even the more expensive areas like Bloomfield Hills. As a result of what's happening in downtown Detroit, there's a lot of opportunities that are presenting themselves in those markets. Those properties were more depressed in the west side of the state, even though they're very nice areas. Southfield, we just put an offer in on a property down in Southfield the other day, and then there's another area down there, Ferndale. It's a turnaround market. It's kind of like downtown Grand Rapids, only a lot smaller. but a lot of the professional athletes live in that neighborhood that have significant incomes. Some of them don't stay very long if they get cut. The property we were in the other day that we wrote the offer on, a lot of the Detroit Lions players come in during the preseason, and they allow them to do short-term leases only because they might end up being on the developmental squad, or they might not be on the Lions at all down the road. So they work with some of the franchises with professional athletes in those markets down there, and the fact they get professional athletes is a big draw for everybody else wanting to live there.
So a lot of the outskirts of Detroit. What about the Detroit itself?
Well, there's a tremendous resurgence and revitalization occurring in the Detroit area, their downtown urban core. It's a very competitive landscape. There are some values to be had. Some of these buildings are just such large buildings that they're going to require a very high level of capital. The main thing is we're seeing investors from out of state and even some international investors looking at Detroit. And so it's starting to create some pricing pressure. And then you've got folks like Dan Gilbert, who he's doing some really wonderful things and trying to bring back that downtown environment. He's up to somewhere between 80 and 90 buildings that he owns now. So if you're going to buy something in downtown Detroit, you may be competing with Dan. But it's a great thing. It's what I always say is that the rising tide raises all boats.
Dan is Quicken Loans, if you try to relate.
Yeah. So Dan Gilbert, who owns Quicken Loans, and you also have Mike Illich, Little Caesars Pizza. Seems like the two of them are really kind of recreating Detroit in the way that they would like to see it created.
And if there were extremely good values down there, I'm sure that a lot of advantage was taken from either one of their perspectives, because both are very, very well capitalized and very well liked within the city.
What's a wonderful thing? They're putting their money where their mouth is. They believe in the area, so I think that's a very good sign. We've had a lot of that going on the West Michigan area for a long time, with wealthy individuals and some of the larger corporations that hail from this area putting money back into the community and investing in infrastructure and assets. So the research facilities that I had mentioned, there's also museums, a convention center, a arena that is one of the top grossing arenas for its size category in the country. And so we're seeing positive things happen really across Michigan. We've had that Rust Belt perception for a long time now, and I think Michigan's finally slowly starting to shed that. We live here, and as you know, Brian, there's so much more to Michigan and to East Michigan and West Michigan than what the national headlines might suggest.
Go to Nebraska and try to find the Big Lake.
Well, we have some natural resources like the Great Lakes that create tourism, and I mean that's a wonderful amenity and resource that isn't going away. And we also have a very diverse economy, and we have a very strong skilled labor force. So these things bode well for the long term. If you look at major metropolitan markets or port markets, or some of the maybe more well-publicized San Francisco, Miami, Atlanta, Manhattan, Minneapolis, some of these places, they may be more known than Grand Rapids or Detroit, or perceived as more positive, but their highs are often higher and their lows are often lower as economic cycles occur. And so there's a certain stability to the Midwest and to Michigan, certainly.
Well, the coastal cities, and Scott and I are finding this out, that the international money doesn't need the yield that the money investors are looking for in the United States, and they're literally chasing the people out of Manhattan and San Francisco and L.A. into Midwest markets to buy better return vehicles. And we're working with people from the West Coast, the East Coast, from Florida, from Canada, from Germany, and they're coming here because they're being priced out of their own markets.
All right. As far as cap rates go, I mean, what my understanding is, you're looking at 2 to 5% cap rates in New York, LA.
Any of the core markets.
Any of the A class or the A markets.
The primary markets.
Primary markets. Thank you.
Yeah, Grand Rapids is considered more of a tertiary market.
Is it still a tertiary
market? We're growing.
Market?
If you look at our MSA, we've got 1.1 million people in the MSA. Mm-hmm. Depending on how they define it, they've changed it several times. But from that standpoint, we're more of a secondary market. But when you look at a place like Minneapolis, where they truly are an 18-hour city and they have grocery stores in their downtown, and they've got pharmacies in their downtown that we don't have some of those retail amenities that you would expect if you were going to live in a downtown area. We have less volatility than those areas though. And so we are growing and we're evolving, but it creates a good value play for someone looking here from outside.
A lot of the big players were at the National Multi-Housing Conference, and I say big players, I'm talking really big players that own thousands and thousands of units. And the panel discussion down there surprised some of the people we had worked with in our market and surprised us a little bit. They identified Grand Rapids as the third best investment market for multifamily housing in small to mid-sized markets in the United States. And the cost of living and the cost of rent and the cost of construction all make it an affordable relationship. So, that statement in itself drew a lot of people into our marketplace.
A lot of people are looking at Grand Rapids who hadn't even thought of it a couple of years ago, huh?
Or even knew about it.
Or even
we get some of that. This guy from Toronto that we were working with said, "Can't you find something for me on the east side of state? Where's Grand Rapids?" So there's an identity crisis there a little bit too.
Yeah, it's really only been the past 4 or 5 years that Grand Rapids has really started to gain national attention. Mm-hmm. Before that, we seemed to be kind of a quiet city.
We got blended in with the southeast side of the state is part of the problem. And you ask where there's still some values to happen. If it comes back, and I know they've had some real issues with their water systems and whatever, but Flint still has a lot of opportunities, but it's still a very depressed market over there. And whether that will come back or not come back, that's to be seen. But there's a lot of properties over there that could probably be purchased extremely well.
Part of the catalyst there, it really seems like here in Grand Rapids, you have the DeVosses and the Van Andels. We talked about Detroit, where you have the Illiches and the Dan Gilbert. You need that money from the private business to come in and sort of sculpt the city.
Mm-hmm. About 20 years ago, when the arena went up, that changed the dynamics of the downtown district substantially. And then shortly after that, the convention center went up, and then the museum went up, and then several years later, the art museum came in. And then when you brought in Art Prize and you gave it national recognition for some of the things that are going on in our community, those are all good events. But we're a unique town. We've got the Detroit Pistons D-League team in here. We got the A franchise for the Detroit Tigers. We've got the Griffins, who are affiliated with the Red Wings. So for a small to mid-sized community, we have a lot of the same opportunities that big cities have, only at a different level.
Scott, you did a video recently for NAI Wazinski where you talk about the market trends and what's going on here in West Michigan. Can you talk a little bit about that, please?
Yeah, on a national level, we continue to see a shortage of housing, both on the for sale side and the rental side. Now, Craig and I, we deal with the rental side, and there are about 1 million units that need to be produced in order to meet the current demand for rental housing.
And this is on a national level?
This is on a national level. Right now, the annual pace of construction is actually now surpassing the average that you would typically see over the past several decades. We're above the 25-year average at around 310,000 units being added. And yet this is playing catch up. And so over the next 3 years, we see that pace will continue to climb, and it'll take about 3 years to make up that million unit deficit. And we're seeing some similar trends in West Michigan as well. Obviously, Michigan has been known as being tied to the big three, and so there was a substantial impact from the Great Recession in terms of employment and population growth. Our economy is actually much more diverse on the west side of the state than on the east side of the state, though things are improving all around. And so we're starting to see things go back the other direction. We're seeing positive population growth and positive employment growth.
In Michigan or in
both Michigan
Rapids,
and
West
especially
Michigan
on the west side of the state. We're starting to see substantial construction occurring, and we're also playing catch up. There were about 5 years where we had almost no rent growth, and there was almost a 10-year period where we had no substantial construction. Therefore, we have a shortage of units, which is causing a tremendous increase in rents. The landlords kind of have the pricing power right now. In Grand Rapids, the annual rent growth is around 8%, which is tremendous.
Wow, that is tremendous. How does that compare to the national rent growth rate?
The national average is about 4.1. If you look at West Michigan as a whole, there are some areas they're actually below the average pace, which would be the normal pace would be around 3%. There are some that are around 1 or 2% if you get into the southwest corner of the Lower Peninsula or toward mid-Michigan. But we're averaging about 5.3% for West Michigan as a whole, which is still a very healthy pace. You do have to look at context in that if we had a flat rate for a while there, this is just kind of making up for some lost time. And it won't be sustainable long term. It will level back out to a normal trend line, probably within the next 2 to 3 years.
So is it a lot of the rehabs and the new builds that are kind of skewing the rent growth higher because they're demanding higher rents?
It is, because a lot of developers or owner-operators are going in and they're taking properties that just didn't have adequate cash flow in the last 5-10 years because of the economy, and they're taking those dollars and they're retrofitting cabinetry, appliances, utility fixtures for sinks, and just a lot of things that give them, and Scotty used the term value add opportunities. And some of them are doing them all at once, and other ones are phasing that in, and they're offering mixed packages. For the guy who can only afford $50 extra a month, they get X, and for the guy who's willing to pay $150 more per month, they get X, Y, and Z. So those opportunities are out there, and then there's some people coming in from out of state who are transitioning in our market with things we haven't seen in the past years, and they're going back, and we call it RUBS, ratio utility billing systems. They're billing back for water and sewer to the units. They're billing back for heat for units that used to have baseboard hot water heat that typically got free heat. So some of these things that they're billing back for were things that didn't happen in the past because of the soft economy, but now they might only raise their rents 5%, but they might be reimbursed another 3% to effectively get that 8% yield or return back on their dollars.
So that rent growth ratio does not necessarily tell the whole picture, because maybe the rent growth isn't as strong in a certain area, but if they're getting the RUBS utility payback system, that can add to the bottom line and increase
certain
net operating
submarkets
income.
are really pulling things upward. The fact that we have population growth and not enough units is just creating any organic growth right now with a shortage of units is going to create an upward pressure on rents. There's some simple economics that are factoring in on the construction side as well. There is, from both the residential side and the commercial side, a tremendous demand for construction and construction labor. So we have a bit of a shortage on the labor side, and that is pushing up the pricing of labor in construction. Materials costs have kind of gone up and down, but in general, they are rising. And so in order to be able to support a new project, you simply have to have a pretty high rent when you look at the apartment side. And so we're mostly seeing Class A product coming online. And that's only going to hit a certain price point. Only a certain demographic can afford those rents. Only certain locations warrant building that type of product. And that if you don't want to build something that's too highly priced for the folks that live nearby. If they can't afford it, then you're not going to rent up. You're not going to be able to lease up the project, and it won't succeed. In our backyard here, the downtown district, the central business district, is where we're seeing the majority of the action. It's also obviously it's the focal point of the metropolis, and so everybody sees all these cranes, and there's a lot of fear that there's overbuilding, and a lot of folks don't realize that in the greater context, we're really not overbuilding. We're catching up. In the suburbs, we're not seeing as much development yet. It's starting to happen, but again, the high cost of delivery is keeping that tempo at bay. In our downtown, we've got a similar situation that we're seeing across the country. Is there's this
in our downtown being the Grand Rapids.
I'm sorry, yes, in Grand Rapids. We're located in Grand Rapids, Michigan, though we work across the state. There's been a general resurgence in interest in living and working in downtown environments. The whole work play concept, and the millennial groups that are getting into the rental pool now are starting to form households. They're more interested in walkable environments and being near their friends and being near the entertainment and activities that they like to do. So it all makes sense. But across the country, many cities don't have a substantial housing inventory in the downtown, and Grand Rapids was certainly in that place. We had almost no market rate inventory. Now we've got a couple thousand units coming online, but we actually have a potential pent-up demand for 5,000 to 10,000 units over the next 5 to 10 years. And so the units, you see all these cranes, and there will eventually be a leveling out where supply will exceed demand, but we're not nearly at that point yet. So it's not a slight supply and demand balance that you would see maybe in the suburbs, where suddenly there's not enough housing, and so contractors start building more apartments, and then suddenly they build too many. Well, we had no demand in the downtown, and we had no supply. Now suddenly we have demand and we have no supply. So once we catch up to that, we'll eventually see this leveling out, and the rents will start to flatten, and the construction will start to slow down. But at this point, that pace is going to continue for another probably 2 to 3 years.
Some of the construction on new apartments that's occurring is only occurring because you're into phase 2, phase 3 of an existing property where all the infrastructure, all the land's already in place. So you don't have to go rebuild that portion of the property or pay for that portion of the property. We just got done doing a valuation on a party that has an existing complex, but they wanted to buy the land next door and add to it. The problem they had is it could only support $55,000 a unit in construction costs, and the construction cost was going to be $87,000 to $90,000 per unit. So the decision was, can't do it. So where Scott's talking about suburban markets, if you're looking at suburban markets where you got average household incomes $60,000, $70,000, and you can get rents of $1,300 a month, you're seeing some suburban construction start. And there's 2 or 3 properties that are either in process or just being completed that are getting rents in the $1,500 to $1,700 a month in the suburban markets. And there's 2 or 3 other properties that are scheduled to come online.
And that's in the suburban markets. What kind of rents do they need to get in the downtown core?
Similar rents. The cost of construction in a downtown environment tends to be substantially higher. Typically, you're looking at demolishing some existing structures. There are going to be more other infrastructure such as utilities and dealing with easements and neighboring buildings. It's just a tighter quarters to be constructing something, and that creates additional costs. There's often environmental conditions or concerns. There was a lot of manufacturing that happened in the downtown environment, at least in our downtown, and so sometimes there's contaminated soils. And the last thing is the style of construction, which is typically you're building a taller building. It's going to be maybe concrete or concrete and steel, or maybe a mix of materials with some wood construction, which wood construction tends to be substantially cheaper. That's what you would see out in the suburbs. So you add all these factors together, and you're going to need a much higher rent because you're going to have a 10 to 40% higher construction cost potentially. And what we're typically seeing is you're going to need some type of subsidy in order to make the numbers work. Almost every project that we see happening in an urban environment in these Michigan markets that we track, the value of the project, of the proposed project, is usually 10 to 20% below the cost of producing it. And so developers are usually playing a game where they have to get some type of a subsidy on their tax bill. These things are reimbursed usually over a 10 to 15 year period, or they're getting some other incentive money from the state or the local government that the state and local government wants to see more tax revenue. So if they have a new project versus an empty lot in the middle of downtown, any additional money is better than none. And obviously, if you have more people living downtown, well, those folks are going to be paying income taxes and creating additional tax revenue for the city as well. So you have to look at the bigger picture. But these projects wouldn't actually occur if they weren't getting these initial subsidies.
So the developers would go to the city and try to get some sort of tax abatement or some other funds to help with the development of their project.
Or a grant or some kind of tax credits that might be associated with it, with the development of the property.
Or they may be a subsidized loan or something like that.
Yeah, I mean, in Grand Rapids, we've got several projects that are in a MISHDA finance state in a Michigan Housing Development Authority, and they get a tier of credits that they can utilize for the construction cost or offsetting the construction cost or operations of the property.
And now you're talking the affordable housing world, where MISHDA or LIHTC or something like that.
Yeah, low-income housing tax credits are available.
And then there are limitations on who you can rent to based on their income, the household income. And so the state will, in order to maintain a certain level of inventory for lower income households, they provide additional subsidies to make up for the fact that the project is going to produce far less revenue long term than a market rate property would. So again, the numbers would not add up if you did not have that additional incentive to the developer.
Sure. So that's a lot of great information, and it brings up a couple questions. First of all, here in the Grand Rapids area, there's all this building going on. My question is, where's the demand coming from? What is it with Grand Rapids that's created such a demand for housing, especially in the downtown area?
Well, we've got a strong employment base, for one. And Scott mentioned before, it's a diverse employment base, and it's home-based with the Steelcases, the Amways, the Myers. They're not going anywhere, and we've got a lot of new expansion of jobs that are looking at West Michigan and Grand Rapids and coming into our market that weren't otherwise here before. So part of it is that, and when you have job growth, you have people moving into the area. So, and then the other one is take a look at the age groups. There's a lot of 22, 25-year-olds that have been living with mom and dad for 3-4 years after they get out of college, who now become employable or have an employment opportunity, who can now look for an apartment and move out of mom and dad's basement.
So you have the millennials who are moving downtown.
To a degree, I think as much as millennials want to live in the downtown environment, there's a pricing issue. So unless they pair up with a roommate or something like that, they may have a challenge with being able to afford the rents. And we're talking north of $1,700 a month for many of these units. We're seeing a lot of young professionals, folks from our medical district. So the medical mile is a very strong component of our downtown that is growing substantially. And there's a tremendous amount of philanthropy. We have the Van Andel Institute, which is a nonprofit entity, and they are doing research into Alzheimer's and
cancer. I mean, they're doing all kinds of research.
Parkinson's.
Parkinson's. Yeah, there you go. Okay, so there's some things like that where they're flying in talented people from all over the world to come be a part of that effort. And so when you have that going on, as well as many businesses are moving back into the downtown area, it's easier to draw in new talent into their workforce if they've got a hip environment. And then also there's just a lot of energy downtown. So there's a lot of things going on. There's a lot of entertainment activities.
Grand Valley's getting ready to build a new medical services building right on the north side of I-96 or I-196, right across from the hospitals. Their expectation is they can service another 1,200 students there that are going to be physician's assistants, nurses, physical therapists, whatever. But they've outgrown the DeVos Cook or Cook DeVos Medical Center is packed, and Grand Valley is going to pick up some of the slack on that. And having the medical research facility, the Van Andel Institute right across the street is a great avenue. And Michigan State's taking advantage of that by bringing their medical school to Grand Rapids, which they're already expanding.
Yeah, they're building their second building already here. Yeah. So, which brings up another question, which has to do with price. I mean, the demand, I can understand the demand aspect and why all this construction is going on. But with these new builds and the rents that they have to achieve, are they going to be able to achieve the rents in order to make these new builds profitable?
You're going to see the style of units are changing. The micro units, the unit sizes are 300-400 square feet in some of these properties that are being built downtown. So if you're paying $2 a square foot, there's a difference paying $2 on a 1,000 square foot unit and paying it on 300. So when they start building smaller unit sizes for single people, you can still be in the same living environment, in the same community downtown, but you're going to be in a smaller relationship to your total housing size.
Well, we're also talking about less than 1% of the total housing inventory on the rental side within our metropolitan area. So it's a subset of the community, and there are plenty of folks who make a strong wage, and yet they're in some type of a transitional situation. They're going to be here for a year. So we have the MSU Med School downtown. So there's some folks that are studying and they're going to be here for a little while, and then they may stay, they may go somewhere else. Again, the folks from the various research centers, we got Lemon Holton Cancer Pavilion is another research and treatment facility. And then professionals who are maybe building a home, or they want to live downtown for a little while before they grow their family. And so there's a lot of different scenarios that are creating that pocket need. And as the downtown grows into a more balanced area where we have both employment opportunities, entertainment opportunities, as well as living opportunities, we'll start to grow from people leaving at 5 o'clock on Friday and you don't see them again till Monday morning, to a little bit more of an 18-hour type city where people actually hang around after hours.
The live, work, and play mentality.
Yeah, absolutely. And that was definitely...
A 24-hour environment, basically, is what you're looking at.
Well, I don't know if we'll get to 24-hour for a while. It's more like Manhattan. But of course, that we would love to have that occur. People, the longer they stay around the downtown area, the more money they spend, which allows the restaurants and shops and so forth to thrive. And the more those things thrive, it draws in more restaurants and shops, which creates more of a reason to be downtown.
And there's a lot of empty nesters, me being one, where our kids are growing up and out of the house. And I don't want to stay out in the suburban market anymore. I want to take advantage of some of the entertainment opportunities and the shows and the things that are starting to happen in the downtown market, the off-Broadway stuff. Go spend some time downtown. We've got lots of restaurants, lots of other entertainment activities down here. We've got an arena downtown where you can go and listen. You've got concert capabilities. You've got event capabilities for sports. It's all walkable, and it's an opportunity. I've got several friends who are now moving into the downtown district. It won't be myself. My wife won't do that, but it's a different environment, and some people really enjoy that.
Craig, I know off mic you were telling me there's really two kind of downtown markets. Could you explain that a little bit better? Well,
there's the Central Business District, which is what most people perceive as being the core downtown district. But there's other people who, as long as it's close in proximity, they can get downtown either by bike or a walkable relationship. We went to the National Multi-Housing Conference in Orlando last January, and they were talking about suburban markets, not being suburban, but suburban, those markets being in close proximity to all the same events and activities that we just talked about, but a little more affordable and maybe just, within a mile of the downtown district, but, definitely, you can get on a bike and ride down, or you can walk down.
So would that include like Heritage Hill, Easttown?
Yeah, those are parts of those markets, and we've got a Northwest Side market now that's redeveloping. Rockford Development's doing some stuff over there, and several other developers are picking up.
And you see a lot of development on the west side as well.
Absolutely, that's part of that. And then Scott's more familiar with that area than I am, but on the northeast end over on Plainfield, which is over in his neighborhood, there's a lot of new development that's starting to happen too. So it's called gentrification, taking old neighborhoods, making them new. And you're seeing people buying up old buildings, sometimes old vacant buildings or blocks of houses, and changing the neighborhood. There's actually a new Meijer grocery store that's going to be going underneath an apartment development on the northwest side, which is really unique.
Yeah, that's an exciting development for the downtown. So overall, just when you look at Grand Rapids and you look at the pipeline of new units that are coming online in the next 5 years, because we can project out that far, right? Well, Scott, I know you already kind of gave us some numbers, but could you just give us an overall view of what the numbers look like now, the demand here in Grand Rapids, and how much product is going to be coming online in the next couple of years?
Sure, yeah. So we put out a biannual construction pipeline report, and right now on our report, we've got around 16 to 1,700 units that are under construction in the Grand Rapids area. Now that's the whole Grand Rapids metro, and not just the downtown area where a substantial amount of the product is coming online. But again, we've got about 10,000 units potential demand over the next 10 years, and we're playing catch up. There's around 3,100 units of approved or proposed product, and you'll see some of those things start to come online over the next 12 to 24 months as well. And so you add that together and you've got 3,000 to 5,000 units. So we're obviously ramping up very quickly. When many properties come online at the same time, that will tend to soften the rents for a little while. If suddenly you have a bunch of options, it's going to be harder for the landlords to keep pushing the rents up. Obviously, affordability is becoming an issue overall, and I think that's where the next pocket of opportunity is. If a developer can start to come up with solutions that give you an intermediate price point to the more affordable suburban product, which is maybe not so convenient to the downtown area or to employment, especially for folks that want something more walkable, and the direct urban environment, which is getting very expensive. And some of those first ring suburban areas that Craig had mentioned are providing some of those opportunities. Some areas like the historic districts, Heritage Hill, Cherry Hill, some of those areas have very little space available to develop anything.
And they're also historic too.
And they're
which makes
historic,
it
so there's
extremely difficult
limitations
to do
there.
that.
There are some other areas where this is why we're actually seeing, you could call it gentrification, which has both, it can have some positive and negative connotations. There's revitalization occurring in some of these areas, and it's a function of location. So it's that proximity, the fact that you have a high enough walk score so that's just it's an independent organization. They have a website where you can type in an address of a property and you can find out on a number of different categories how walkable the property is. So that would be to shopping, to entertainment, how easy is it to get to employment, can you walk to work? And so those higher walk score areas are going to draw in folks who want to be near downtown but can't afford downtown.
Well, Scott and Craig, thank you so much for taking the time to talk to me today. I think I've learned a lot. Hopefully our listeners have learned just as much. I really appreciate you sharing your time and expertise.
Thank you.
Thank you.
So before we go, I want to take a moment and talk about the Rental Property Owners Association. And if you've been listening to this podcast, you know that a lot of the guests that I've had on this show are members. And as a member myself, I can tell you that the RPOA provides a lot of value, not just to me, but to all Michigan rental property owners and real estate investors. And right now, they are offering a 50% discount on first-time memberships by calling this number, 616-454-3385. And you can call that number Monday through Friday. And if you mention this podcast, you'll get a 50% discount on a first-time membership. And once again, that number is 616-454-3385.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.